Good morning, everyone. Thank you so much for joining us today. My name is Hajra Talat, and I will be your host for today's webinar on common VAT mistakes, consequences, penalties, and best compliance strategies. So, before we dive into the session, let me provide a brief introduction about our company, ACME Group. ACME Group has established itself as a trusted tax and financial solutions provider across GCC region and Egypt. We are committed to delivering high quality solutions tailored to the needs of various businesses across different industries. Our focus on quality and expertise has allowed us to build long term relationships with our clients. Our exceptional team consistently delivers value efficiently, making us preferred service provider in the region. So now let me introduce our esteemed speaker for today's webinar, which is Mr. Rosh Regi. Mr. Rosh is a senior tax associate, ACCA professional with over 3 years of experience. He is proficient in tax documentation, return preparation, and client advisory on compliance. He excels in managing tax registrations, penalty waivers, tax refunds, reconsideration requests, and providing strategic advice to businesses operating within UAE. His expertise include overseeing excise tax, federal custom regulations, litigations, and preparing expert report for audits and fraud investigations in UAE. Sorry. So before we start, I'd encourage everyone in the audience to share your questions in the Q&A sections. This will help create an interactive session and ensure that you gain maximum value from today's webinar, as your participation is very essential to the success of this event. I would now like to invite Mr. Rosh to commence the webinar. Over to you, Rosh.
Hello, everyone. Good morning, and welcome to this session where we will be talking about the common mistakes and the pitfalls when it comes to the UAE VAT regulation, following the UAE VAT regulation, and the consequences, the penalties, and what are the best compliance strategies that we can follow. So before I begin, guys, do you want me to wait for another 2 minutes so we can have more people joining the session, or shall I start? Okay, I think, yeah, we can start the session. Okay, so before I begin with the session, I just want to say a disclaimer or an introductory message. That is, this webinar is meant for someone who is relatively inexperienced, basically a beginner. All right, when it comes to the following the VAT regulations in the UAE. So the agenda for this webinar is not that it's a proficient tax advisory webinar, but it's just about to cover the basic mistakes, and when we're going to talk about the basics of VAT and how you can avoid the common mistakes that we as consultants that we see. So if you would like tax advice, specific tax advice, you can always reach out to us. We are always available, and we are happy to help when it comes to if you have any specific questions that we can give you tax advisory solutions that is custom made and tailored for your needs. Okay, so we will be talking. Let's move on. Next slide, please. Okay. So, what is VAT and why is VAT important? Firstly, value-added tax is a tax regime. For those of you who do not know, is a tax regime implemented in the UAE since 1st of January 2018. It is one of the first indirect taxation regulations that was brought to the UAE. And this is a consumption tax on goods and services. All right, this is the standard VAT rate is 5%, and there are cases when they are subject to differ based on certain criteria and parameters, which we will talk about. Okay. Now, secondly, the UAE VAT law requires businesses to register, charge, collect, remit VAT on the VAT to the FTA. Okay. So businesses who have meet that there is a threshold for registration, and businesses who meet the threshold and who cross the threshold are required to register for VAT and charge and collect, I mean, charge VAT on the supplies that they are making, and are required to submit their tax returns based on the regulations specified by the FTA. And when point three, compliance is not optional. So it's a legal obligation, and there are serious consequences when it comes to non-compliance, and so which we will be talking about the penalties, the exposures, the risks that a taxpayer might face when it comes to non-compliance. Next slide, please. Okay, so we will be starting our session with a couple of mistakes that we as tax consultants we've observed. These are again, like I said, these are basic, some of the common mistakes that we've seen happening, and we would like to address them in today's session. Okay, mistake number one: not issuing a proper tax invoice. Okay. So this is something that we've seen very common, and that this is something that's very common among small business entities, and it's very common between the small businesses, as well as there are some major bigger companies as well that we've seen this mistake, that is not issuing a proper tax invoice for a taxable supply that is made by a registered taxable person, right? So a tax invoice is a legal document detailing the transaction. Okay. It specifies the tax information of the person making the supply, their their TRN, the address of the company, the date of the sale, the seller, the customer's information, and goods or services that were sold, and the applicable VAT rate. So it is an exhaustive, there is an exhaustive list of requirements that are required in and what we've seen is one of the common mistakes that we've seen is that businesses do not issue a proper tax invoice. So there is a list of requirements or a checklist that you must follow when it comes to issuing a tax invoice, which is specified under Article 59 of the Executive Regulation of the Decree Law, or VAT in the UAE. Okay. The consequences of not issuing a tax invoice is the penalties, right? And firstly, the penalties, as per the cabinet decision 40, if I'm not mistaken, there is a fixed penalty of 2,500 for each detected case where the taxpayer has not issued a valid tax invoice for a taxable supply that was made. Okay, that is for each transaction, for each instance. So that is the penalty for non-compliance, and it is difficult for the customer to claim input tax. So the customer, if the customer is registered for VAT, then it becomes difficult, increasingly difficult for the customer to claim the input VAT on these supplies, because again, the criteria for claiming input VAT under box 9 standard rated expenses is that you must be possessing a taxable invoice. A tax invoice in order to claim such expense. So that's one of the most common mistakes that we have seen, and yeah, we would like to address that as the first mistake because this is something that we've seen often. Okay, next slide, please. Okay. Again, another mistake that we have seen among small business entities is not maintaining proper bookkeeping or not having a proper bookkeeping function or books of accounts. Okay. Now, what are books of accounts? So, those of you who do not know, books of accounts are basically to do with that the books of accounts are a record of the financial transactions, and it's a summary of the transactions that you do on a daily basis as a business. And you have different types of you have the general ledger, you have journals, you have trial balances, and the figures of that leads to the balance sheet, statement of financial position, and you have another books of account. It's called, you have an other accounting book that is called the profit and loss statement, where you have your incomes and you have your expenses, you have your cash flow statements, and so on. So these things, you will be maintaining these things if you have a proper bookkeeping function or you have an accounting software. Okay. Now, what we've seen is that small businesses, and this is common among sole traders or sole proprietorships, where um, they do not have a proper maintained books of accounts or records of the transactions that they want to take in, and this could be either this could either be incomplete. Okay, there could be transactions that are missing, even if, say, for example, they do maintain an Excel sheet or whatever they are maintaining. There could be cases where it could be incomplete or it could be inaccurate, and or it could not exist at all. Okay. Now, the FTA, the consequence of that is the FTA specifies in its rules and regulations that every registrant or every business owner must ensure to maintain the proper books of accounts and proper records related to the transactions that they undertake. Okay, and the FTA can issue serious penalties for failing to maintain these books, and there could be instances where they may disallow the claiming of certain expenses if you have claimed them in the past returns. Okay, so it is essential and it is vital for businesses to ensure that they maintain proper books of accounts and have a proper bookkeeping function. Um, so, yeah. Next slide, please. Okay, so this is something we So this is something that we spoke about in the first mistake when it came to the last point, right? Where the customer may not be able to, may face grave difficulties if you as a supplier, you do not issue a tax invoice. And so this is from that point of view, from a customer point of view, or now that you have incurred certain expenses for which you have paid tax to the supplier, and now you would like to recover it uh, from the FTA. Okay. A mistake, a common mistake that excuse me, common mistake that we find is that there are registrants who claim the input tax on the expenses without possessing a valid tax invoice. Again, to reiterate, a tax invoice, like I said, is an official document that is issued for tax purposes, where you have certain list of information that are specified under Article 59 of the Executive Regulation of the Decree Law. The point being, you can only recover input VAT, if you have a valid tax invoice from the supplier. This is clearly specified in the executive regulation of the decree law, where you are only supposed to claim expenses, input VAT, if you possess a valid tax invoice. So what we've observed, a mistake that we've observed is, there are businesses that claim input tax based on pro forma invoice or delivery notes or regular receipts. Could be cash receipts. It could be any form of document where you just acknowledge the fact that you've paid a certain amount of money. But this is not right, and you need to ensure that the requirements, even as you as a customer, if you are registered for VAT, before claiming these expenses, you need to ensure that even if, say, for example, the supplier has issued something that is written and or has a title of tax invoice, you need to ensure that all the parameters that are specified in the law are fulfilled in this document that is issued by the supplier. Okay, and the consequence for that is the FTA may disallow the claim, okay, leading to a tax liability and potential penalties. This could probably happen at the time, it may be when the FTA issues a tax audit on you, and the FTA finds out, the officer finds out that there have been transactions that you do not have a valid tax invoice, and you have claimed for it. So the FTA could ask you to reverse such claims, and may also impose penalties on the due amount, which could be huge. Okay, next slide, please. Okay, this is a link to the mistake number two that we spoke about previously. That is, this is linked to that. That is of not having a proper bookkeeping function or maintaining books of accounts. So one of the books of accounts that I had spoken about in that slide is the trial balance. Okay, so the trial balance contains the list of balances of all the ledgers that you maintain, okay, on a debit and credit basis. Right? And This is also an accounting record, and the mistake that we've seen, I mean, this builds on onto the mistake number two. And say, for example, there are companies that that do maintain a trial balance. However, at the time of VAT returns, they do not perform something that we call a trial balance reconciliation or a TB reconciliation. Okay, where they match the input and output VAT balances. Ideally, you're supposed to be having two ledgers about the input VAT and the output VAT when you maintain journal entries. Okay, and you will have a ledger and you have a balance of input VAT and output VAT, and you should ideally check the balances of the input VAT and the output VAT, and if it is matching with your VAT returns, and if your revenue figures as per the trial balance is matching or is consistent with your VAT returns figures. So, trial balance reconciliation matches the VAT declared on your VAT return with the figures in your accounting records. So, this is it's a sort of reconciliation that you do based on the trial balance that you have for a particular period. I mean, for the tax period that you're filing your tax returns. The mistake is obviously not reconciling the trial balance with the VAT return information, or the reconciliation performed is inaccurate or incorrect. Okay. Now, the consequence of this is that the discrepancies lead to scrutiny by the FTA. It could trigger during the time of audits, and it could also trigger penalties. Okay, the reason for that is because at the time of FTA audit, one of the first things that the FTA asks for is the trial balance for the particular period. Okay, and one of the first things that they do is they match the trial. They perform themselves the trial balance reconciliation. If they are able to match the figures with the corresponding VAT returns, and if not, if you're not able to match those figures, then that could lead to further questions and further suspicion, and that could increase the risk exposure of yourself at the time of FTA audit. Okay, next slide, please. Okay, so we have a poll question for the audience, and this is the first of them. And the question is, what is the excuse me, what is the mandate? What is the mandatory registration threshold for VAT registration in UAE? What is the threshold figure? I spoke about this in my first slide. There is a threshold that companies must meet in order to be registered for. So, what is the mandatory registration threshold? And the polls are open for you. Okay, I believe the time's up. Okay, what is the mandatory registration threshold for VAT registration in the UAE? The answer to that is 375,000. That is if your taxable supplies exceed 375,000 cumulatively over the last 12 months, or if you're anticipating your taxable supplies to cost 375,000 in the next 30 days, you are required to register for VAT and the UAE. 187,500 is the voluntary registration threshold, where if your taxable supplies have crossed, excuse 187,500, then you have the option to register for VAT, but it's completely optional, and it's totally dependent on you whether you want to register or not. But 375,000, as soon as you hit 375,000, you are required, and it's mandatory that you are registered for VAT. Okay, moving on. Next slide, please. Okay. Can I have 1 second? Okay. Mistake number 5. Thank you, and apologies for that. Input tax recovery errors. So I spoke about one of the mistakes that I spoke about previously is not claiming. Mistake number 4 was not claiming. Claiming expenses without having a valid tax invoice. So this is one of the mistakes that we see when it comes to claiming of input VAT. Uh, uh, Building on to the incorrect claiming of expenses is recovering blocked input tax. Okay. what are blocked input tax? There are, ideally speaking, you can only, so simplistically speaking, yeah, you can only recover expenses that are related to the business and which helps you undertake your, conduct business activities and make taxable supplies. Okay, expenses that are related to or which facilitate in making taxable supplies. So certain expenses, there is a public clarification issued by the FTA earlier on. In, I believe, 22 May of 22, regarding the blocked expenses and non-recoverable expenses. And some of the expenses under those non-recoverable expense list relates to entertainment expenses. What we've commonly seen when it comes to entertainment is that, say, for example, entertainment expenses and staff accommodation, transportation, and some of the motor vehicle expenses. Okay. So to give an example, say for example, you have your business has just celebrated a successful financial year, and you decide to, reward your employees with a day out. Okay, and you go to this fancy restaurant, and the lunch is on you, and you decide to pay for your employees lunch, and you decide to, okay, fine, let's go for a movie, or let's go for bowling or something, basically fun, right? And any input VAT, or any VAT that you incurred on these expenses, like entertainment expense, like the amount that you pay at the restaurant or for any of these activities, any of those, the VAT incurred on any of those expenses, you are not supposed to be claiming from an UAE VAT law or an input tax perspective. And similarly, say for example, you purchase a motor vehicle. Okay, let's say you purchase a car for company use, but this is not just any car, right? This is probably a Porsche or a Ferrari or something luxurious, right? Which technically does not. I mean, you cannot claim the expenses on luxury vehicles when it comes the recovery of input tax. And so the mistake is, yes, obviously, claiming of such expenses under the pretense that these are business expenses, right? And you are claiming input tax on these blocked input expenses. And the consequence for that is, obviously, the FTA, if found, the FTA will ask you to reverse, or they will definitely disallow the expenses. They will ask you to reverse the claiming of such expenses, and you will be required to pay the penalties on errors that were identified, or the differential tax percentage, if not out. So, yeah. So that is one common mistake that we see when it comes to recovery of certain expenses that you're not supposed to. Next slide. Okay, mistake number 6: disregarding VAT apportionment. Okay. To illustrate this, right? Taxable expenses. Okay, taxable expenses you can claim in your VAT return. And when it comes to expenses that you are incurring for exempt supplies, right? When you are making exempt supplies, you are not supposed to be reclaiming the input tax on exempt supplies. One of an example for exempt supply is a supply of bare land, and another common exempt supply that we see is the supply of residential buildings after the first supply within the 3 years. So the first supply of a residential building within the 3 years after completion is zero rated, and the subsequent supply falls under the exempt supply category. Okay. So if businesses are, so this is just an example. Okay. So now businesses there, I mean, like say for example, you are a business and you have both, you make both taxable supplies as well as exempt supplies, right? And you incur business related expenses, say for example rent. Now these are common expenses. I mean, you cannot really apportion it. I mean, you cannot really say that, oh, this the rent that I'm paying is, I mean, just for the taxable, or this much is for the exempt. No, it's for both, right? You as a business, you are making both of these supplies. And so can you, the question is, can you claim the entire amount, or any, I'm just saying an example of a rent, but say for example any other expenses that you are incurring to make both taxable and exempt, can you claim the entirety of it under the pretense that there is also you're making taxable supplies, so that means you can claim all of the expenses, common expenses? um, the answer is no. Okay. How you can claim, oh, of course, like I said, taxable expenses you can claim. Okay, expenses incurred to make taxable supplies you can claim, no doubt about it. When it comes to exempt related supplies, the expenses related to making exempt supplies you cannot claim. Now, about the expenses that you are incurring, common expenses, how can you claim that? Well, the FTA specifies you do something called as input tax apportionment, where you calculate the recoverable percentage. You take a prorata of the common expenses, you take the recoverable percentage, you apply it to the common expense, and that is the amount of expense that you can claim for as input tax. So the formula is recoverable expenses, total recoverable expenses divided by recoverable plus non-recoverable. So that is the total expense. Recoverable plus non-recoverable, you get the percentage of excuse the expense that you can recover, and that is what you're ideally supposed to be recovering. And the mistake is not applying the correct apportionment methods to recover the input tax on general business overhead. These are related to overhead. So not applying the formula is common, excuse me, common mistake that we see, and the consequence of that is the incorrect tax recovery, leading to tax dues and penalty. Consequences of these are severe. Uh, Next slide, please. Mistake. Another mistake that we see when it comes to is the misclassification of supply. Okay, you have different types of supplies as per the way. Taxable supply is supplies that you are making and for which you are charging 5% VAT. Most of the supplies that is undertaken is a taxable supply of goods and services, unless you have certain criteria. So they fall under either zero rated or exempt supplies. So what's the difference between zero rated and exempt? Well, if you are making zero rated supplies, you can claim the input tax incurred on making those supplies. However, for exempt, you can, I mean, you are charging when you're making the supply for zero rated, you're charging a VAT rate at 0%. Basically, you're not charging VAT to the customer. However, any expenses that you're incurring in order to make those supplies, you can fully claim in your VAT returns. And when it comes to exempt supplies, you can neither charge a 5% VAT rate, or nor can you claim the expenses in input VAT expenses on making such supplies. Some of the examples for zero rated include export of goods and services. Of course, there are certain criteria and conditions. Another example for zero rate, like I said before, is the first supply of a residential building within 3 years of completion. Okay, and the subsequent supply of that of the residential building would be exempt. Another example for exempt is financial services, supply of bare land, and local passenger transportation fall under the exempt criteria. So identifying whether a supply is taxable zero rated or exempt is critical and crucial because you are going to report these figures to the FDA, and the tax rules change when depending on the type of supply. The tax rules change, so confusing zero rated with exempt, all right, where that is a common mistake, all right, because for both, for zero rate and for exempt, you're not charging VAT, but the rules are different, all right. And confusing whether a particular supply or a transaction fall under zero rated or exempt, the rule is different, the tax calculations are different, and the recoverability is also different. So that's a mistake that we see, and the consequence of for that is incorrect VAT calculation, leading to tax underpayment or overpayment and penalties. So, misclassifying transactions could result in tax differences. And when it comes to tax differences, and if found out, you will be paying massive penalties for some, I mean, for a misclassification. So it's very important that you know the supply that you're doing, that undertaking, which under which category it falls in. Okay, next slide. Okay, another poll question for the audience. The address of the issuer of tax invoice must be present in the tax invoice. True or false? You have 30 seconds. Okay, I believe the time's up. And the answer for that is true. The address of the issuer of tax invoice must be present in the tax invoice. It is one of the criteria specified under Article 59 on tax invoices, Clause 1. And yes, irrespective of whether if you're issuing a full tax invoice or a simplified tax invoice, the address of the issuer of tax invoice must be present in the tax invoice. Moving on. I think we're running a little short of time, but let's see. Okay, next slide, please. Okay. Another mistake that we see is the conversion of foreign currency transactions. So when it comes to you're making supplies in foreign currencies, and you're accounting for that in the VAT return, it is zero rated or if it's exempt, or even if it is expenses that you want to claim, any expenses that you incurred in a foreign currency. Okay. The law requires, as per the executive regulation of the decree law, the law requires the usage of a daily exchange rate that is published by the Central Bank of the UAE on their website. Uh, to use that particular day's rate for the currency that you've incurred this transaction, and as per the date of supply rules. Okay. So the mistake that we've seen is there are companies that are using the exchange rate as per third-party websites such as Bloomberg or Yahoo Finance or XE. So at the reporting, the day that you are reporting these figures, or like you're preparing your VAT returns, and the rate as per now, if it when it comes to the USD, it is a constant 3.6725 dirhams per dollar. However, there are currencies that fluctuate, such as, for example, the Indian rupee or when it comes to the Pakistani rupee and so on. So you have currencies that do fluctuate with the rates and stuff. And like even example, the euro, for example. So the mistake that we see is using a different rate that is different from the daily rate. I mean, the rate at which you that rate of the date of supply in which you incurred this transaction, as published by the Central Bank of the UAE, using a rate apart from that. Maybe it could come from, if it is a big organization, it could come from the rates could come from your treasury departments. And so you're using that rates, which is different from the one published by the central bank. And the consequence for that is the mismatch in declared tax. Maybe this could lead to a wrong recovery or reporting of tax figures, and again that could result in that. So these are some of the common mistakes that we've seen happen, and we'll be talking about like the consequences and the best practices that you can follow. Next slide, please. Okay, so as discussed throughout, I think we've covered the consequences as well, along with the mistakes when talking about. So, financial penalties, one of the consequences of small clerical mistakes or VAT errors is the financial penalties. Say, for example, like the late payment penalties, which is 2%. So, if you have submitted the VAT return and you haven't made the payment for this by the deadline, so there is an instant 2% penalty. Say, for example, your returns are due on 28th of September. You've submitted the returns and you have a payable figure of, say, for example, 50,000. Okay. And you have not made the payment within 28th of September. And as soon as 29th of September hits, you're hit with a 2% penalty on the payable tax and 4% from the month, like from 29th of October, as in 1 month from the due date. So and then 4% per each. Okay, so that is an example for late payment penalties, late filing penalties. You have 1,000 dirham fine for the first instance and 2,000 for subsequent instances of filing of late filing, and you have incorrect. There are penalties for incorrect returns and non-compliance. Okay, that is one, and the other one is FTA audits. Okay, if the FTA at the time of maybe example, you've submitted a refund. Excuse me, submitted a refund and the FTA has observed like some major inconsistencies or they've identified certain risks when it comes to claiming of expenses, they could potentially open up an FTA audit and a full scope of audit, which could be time consuming, not just the consequences of the risk when it comes to the financial risk, but also it could be time consuming, it could be taxing, and it could be challenging because of they do issue like deadlines when it comes to submission of data to at the time of the audits. Refund delays. So in case of examples where you have say you have I mean you're in a refundable position, filing of incorrect tax returns could cause a significant delay when it comes if you're planning on submitting a refund application for that tax returns, or they may even block the VAT refund, or they may even reject. There are cases where the FT has rejected the VAT refund claim because of an incorrect VAT return submit. Okay, moving on. Next slide, please. Okay, as I've spoken about previously, the late filing penalty would be 81,000 for the first instance and 2,000 for subsequent instances within a period of 24 months. And that is the issue with late filing. So if you have a VAT return deadline of 28th of the month, again 29th of September, if you haven't submitted by 20th and it's 29th, you will be having a penalty if you have the VAT returns. And there is a late payment. Like I said before, if say for example, you've submitted the returns, but you have not the payment is not reflected in the FTA system, so and you have not made the payment. then you have an instant 2% penalty following the deadline of submission of returns, and you have a additional penalty of 4% per month following the deadline of that particular deadline you missed, and it will be 4% per month, and the total penalty be capped at 300%. Tax audit failure penalties for failing or providing documents or obstructing an audit could be major. It could go up to like 50,000. So be careful on that. And these are just few examples. All right. Now this is not an exhaustive list on like the what are the penalties that are you're going to face with if in instance of non-compliance. Obviously, we cannot go over all of them given the time crunch. Next slide, please. We'll be talking about an instance where what we've observed in the market. Next slide, please. Okay, before that, we have a poll question for the audience. VAT on expenses incurred by a company on taking its employees to lunch. What we spoke about previously. For a successful year completed can be claimed. True or false? Guys, what do you think? Expenses on a company incurred by a company on taking employees to lunch for a successful year completed. Can you claim the VAT on it or no? Okay, I believe the time's up. The answer is you cannot claim the expenses incurred on entertainment or recreational services, like I mean, recreation activities that you have taken when it comes to these fall under the category of blocked expenses. Okay, now as I said, we are going to talk about a case study of let's say company A. Okay, it's a large corporation having operations across real estate, hospitality, healthcare services, etc. Okay, a large conglomerate, and the situation was that the FTA had conducted a VAT audit on this particular company. Okay, and the FTA had identified, so the FTA had the suspicions on the business activities after they had submitted a VAT refund claim where they had observed inconsistencies with the accounting records and the invoices and the claiming of expenses and so on. And so the findings of that audit was one of them being incorrect apportionment method used. As I said, the one of their wings is the real estate sector. So as I said previously, expenses that you're incurring on a building, and you have. So that building has like commercial units and residential units. If it is after 3 years, the first supply has completed, and the first supply of the building has been completed for the residential units, and you also have commercial units. Now, any expenses on the building, say for example, you have a paint job or something, or for the whole building, you need to use apportionment methods, and you need to have something called as a wash-up calculation. And what the FTA had found out was there was no such practice that they followed, and they ended up claiming all of the expenses, even those related to making exempt supplies. So that is the use of incorrect apportionment methods. Not claiming of non-recoverable expenses, claiming of input tax on, say for example, entertainment expenses and other disallowable expenses. Where, like you don't have the you are claiming expenses on certain supplies that you're not supposed to be. Say for example, the exempt expenses. Yeah, that is another finding. And another finding of the audit was revenue reporting mismatch. So, like I said, the FTA initially itself, they ask for the books of accounts, the ledgers, and they cross-verify or they reconcile it with the VAT return submitted for the period, and any inconsistencies would trigger further investigation and requesting answers for why this was not reported. And so that is something that they have. The FTA had found out that they were not able to match the revenue figures reported to the FTA with the accounting records held by company. And finally, the inadequate documentation. They were unable to. They have claimed a lot of expenses where they were not able to furnish a full tax invoice or a simplified tax invoice for the taxable they had incurred, taxable expenses that they had incurred, and they had claimed input VAT on. So this is a real life scenario. Moving on, now we can talk about how we can, what are the best compliance strategies. So next slide, please. We'll be talking about the compliance strategies that you can follow to ensure that your business is. Okay, lessons learned from company A. There is an inefficiency. What you can see is an inefficiency when it comes to the internal controls. If they had, it wouldn't have resulted in such a horrible assessment when it comes to the exposure of the financial risks and so on. Apportionment, businesses mix supplies, like I said before, must follow the correct apportionment methods. The FTA has published public clarifications for to educate and inform more about the standard apportionment methods. You have the special apportionment methods, and you have to do something called as the annual wash up calculation, and so on. So being aware of these kind of things and making sure you are implementing those uh, formulas and frameworks. If you have mixed expenses, blocked input tax, you're supposed to be having a clear understanding of, okay, what are the expenses I can claim, what are the expenses I cannot claim, and documentation, ensuring that you have a proper record keeping and a strict policy of claiming only input tax on those expenses or transactions where you have the full set of documents to prove that yes, we have the full set of documents. And yeah, the audit resulted in a significant tax liabilities goes without saying. Significant tax liabilities and penalties for company A. Okay, next slide, please. How to avoid such mistakes? Obviously, being proactive having proactive compliance strategies, and some of which we can talk about right now. Ensuring you have regular reviews that you are undertaking when it comes to your VAT return reviews and internal accounting records. Ensuring that whatever the policies that you're following, it's accurate, it's in line with the law, it's in line with the accounting standards that you're following. Ensuring regular reviews, robust documentation, ensuring that you have strict internal controls when it comes to the documentation that you're holding, and ensuring that each of those documentation are fully in compliant with the UAE VAT laws. Correct accounting methods, using an accounting system or a software that is compliant with VAT regulations. Companies use Oracle, SAP, Zoho, QuickBooks Pro, and so as long as you have an accounting software that correctly, and that accurately report and record your transactions here on the clear. Training, ensure that your accounting staff, if you're doing it in-house, if your tax function is in-house and you're doing it within your accounting department, ensure that the staff that you have are are well versed with the UAE VAT laws and well trained, when it comes to compliance and regulations. So having webinar sessions, or like ensuring they are enrolled in a course, VAT related course, can help a lot. Next slide, please. Can we move on to the next one? Okay. Poll question: what is the standard deadline for filing of VAT returns? So by when must you submit your VAT return? Now it can differ from company to company. Please start the timer. It can differ from company to company, but we're asking about like what's the standard deadline date that you have for. So is it 28th of the month after the end of your tax period, or is it 30th of the month? What's both are towards the end of the month. Okay, the time's up, and the answer is 28th of the month after the end of tax period is the deadline to submit the VAT returns for the particular period, unless 28th falls on a Saturday or Sunday, in which or a public holiday, in which case it will be shifted to the next business day. Uh, Moving on, best practice checklist: ensure that you have valid tax, ensure that you're collecting, issuing valid tax invoices, ensure that you're performing trial balance reconciliations for every VAT return, and ensure that you have record keeping, maintain all books of accounts and records for at least 5 years. This is the 5 year is what the FTA specifies when it comes to records. You need to have your records and transaction records for the last 5 years. Okay, we've spoken about this. Next slide, please. Okay, correctly classifying supplies as taxable zero rate or exempt. For this, you obviously need to know what each of those supplies, what the kind criteria, conditions, and parameters are for these supplies, ensuring that you are claiming input tax on eligible expenses with proper documentation, such as tax invoice, and ensuring that you are only claiming on expenses that are recoverable. Okay. Apportionment methods, if applicable, correctly apply the VAT apportionment method that is related to your set of transactions you have, and if you're using a special method, it needs to be you need to request. You need to get the permission or approval from the FTA for the usage of that particular treatment method. And so, you need to ensure that you're staying on top of those things. And foreign currency transactions using the UA central bank rate, daily rate published by as of the date of supply that you had that transaction. When it comes to conversion, rather than using the rate as per an external party or an external website or from maybe your treasury department. Moving on. Okay, last question, I believe, for the audience. Is it okay to make the payment after the submission of VAT return? You have 30 seconds, and please start. Okay, time's up, and the answer is it is not okay to make the payment after the submission of VAT returns. I mean, okay or not, it's completely on you. But will you incur fines if you do not make the payment within the submission of VAT returns or the VAT return deadline? Yes, you will definitely incur penalties if you do not make the payment within the deadline. Next slide, please. Okay. So again, talking about proactive measures, staying informed, regularly check the FTA website for updates and guidances. The FTA regularly issues public clarifications for to get a better understanding on. There are gray areas, and the FTA is also aware of those things, and so they do ensure to issue public clarifications. And there are times when the law is changed. So do keep an eye on the FTA website. Get professional advice. Consult with a VAT expert or tax advisor to ensure full tax compliance, such as ourselves. This is what we do for a living. So uh, we ensure we do these things for you. We ensure that we are staying on top of the recent legislative changes, and ensure that we are looking at your businesses. If we are being consulted, we are ensuring to look into your business and what's applicable for you, what's not, and obviously to have an expert take care of those things is another proactive measure that you can follow. And having internal controls, establish strong internal controls and approval processes for VAT related transactions, making sure that you have persons who are aware of the law, in charge of these things, in order to avoid such pitfalls. Next slide, please. Okay, that's it from my side. Thank you so much for tuning in. I hope the session was helpful and useful. And like I said at the start, this is not something specific or tailor made for your business. So if you would like us to review your businesses or your transactions, by all means, please feel free to reach out to us, and we'll be happy to look into it. And so, thank you so much, everyone, and over to the team for the Q&A session.
Thank you, Rosh. You even did my part as well for the ending. So let's move on to the Q&A now. The questions that our wonderful audience is putting in, let's dive into them, and let's see what they have for you to understand about. And okay, so one question that we have from Mr. Ashik is, can VAT on health insurance premium paid by company for staff and family members be claimed?
Okay. So this is thank you, Ashik, for the question. And this the FDA has clarified its stance on the claiming of health insurance when it comes to the employees. So you can the health insurance is for employees and their one spouse, and up to three children, but below the age of 18. Okay, so it's only for these set of employees. I mean, these set of people that you can claim as a company if you are paying for the health insurance or for their insurance.
Mhm.
So
Okay.
that's the.
Okay. I hope, Mr. Ashik, your question is answered. Next question is from Mr. George. What are the expenses falling under zero rated and exempted supply?
Okay. You have these are expenses. When it comes to expenses, it depends on the expense that you have when it comes to making the zero rated or exempt supply. So the supply in itself of zero rated, there are examples. There are multiple examples. Like I said, previously, first supply of a residential building within 3 years of completion. This falls under a zero rated supply. So this is a supply, and any expenses you have on making these supplies, this like say for example the construction of the building and the maintenance costs and so on. So these kind of expenses, if it's incurred for this supply of first supply, then yes, it is. This is considered zero rated, and you can claim the expenses. But say, for example, you are incurring expenses on the building after the first supply, then the supply after the first supply, or the supply after 3 years of completion of the building or the construction of the building is exempt. So any expenses you are incurring, like say for example, maintenance costs or something like that, you're not supposed to be claiming the VAT on it. So The difference between exempt supplies and zero rated is that the claiming of the input VAT on it. Now, what are exempt supplies? You have examples for exempt supplies that are financial services, supply of bare land, local passenger transportation, and like I said, the residential first supply and the subsequent supply of a residential unit. However, for zero rated, examples could include the healthcare services. If you, as a as a healthcare provider, if you are providing preventive treatment, these supplies fall under zero rated. So, zero rated supply. Similarly, export of goods or services. These supplies fall under the category of zero rated. So, expenses you are incurring on these conduct making these zero rated supplies, you can claim the input VAT on.
Understood. Understood. Thank you, Rosh. Next question is by Ricardo da Costa. What exchange rate should be used when reporting services received from abroad, invoices invoiced in foreign currency?
I'm sorry, can you please repeat the question?
What exchange rate calculation should be used by when reporting services received from abroad invoiced in foreign currency?
So the exchange rate that you must be using is per the date of supply. So you need to calculate the date of supply. Okay, you need to check the date of supply. Sorry, and as of the date of supply, say for example, you are getting this. You've received the supply on 18th today. Okay, or 17th. 17th of September 2025, you've received a supply from a foreign supplier for services related to here. Okay, the place of supply is UAE. Okay,
Mm-hmm.
now when it comes and you're invoiced in, say, for example, euros. Okay, now these euro keeps changing, or if you're invoiced in, say, Great Britain pound, GBP, or yen, or these kind of currencies, they fluctuate. So the
Mm-hmm.
rate that you must use for the exchange rate that you must use is the exchange rate published by the UAE Central Bank as for this particular currency as of the date of supply, that is 17th of September. So this is the rate that
Understood.
you must be using, not
Understood.
like.
Understood. Understood. Thank you, Rosh. Next question is by Mr. Fariduddin. Can we claim the input tax for zero rated goods?
This is a very open-ended question, right? The short answer is, in general, yes, you can claim the input tax incurred on, I mean, if you are making zero-rated supplies. But again, it sort of goes on to the documentation. Is the documentation that you have, is it sufficient to prove that these supplies that you are making, is it zero-rated? That's the real question. So to answer your question, we will probably need to look into the documentation that you have, if it is fully in compliance with the regulations, and so if so, yes, definitely you can claim expenses related to the related.
Definitely, you're right, Rosh. So next question we have from is Martina. She's asking, how do you deal with VAT on non-tax refundable expenses? Let's say employee entertainment. Do you book the gross amount as expense, or do you need a special account for non-recoverable 5% VAT?
I believe this is a more of an accounting. You're asking
Yeah,
more for an accounting
yeah.
treatment. So when it comes to the VAT treatment, I mean, it depends on how you have your ledgers and books of accounts in place, right? But when it comes to the VAT treatment, of course, you cannot claim the disallowable expenses in your VAT return. So you must exclude them from your VAT return. Specifically talking box 9 standard rate if they are on your.
Okay, understood. Next question is from Marisol. She's asking, can a company recover input tax on office expenses like pantry supplies, cleaning items, other consumables?
Again, if expenses are related, or if you can demonstrate that this are somehow linked to the supply, or making taxable supply for the organization, then yes, you can claim expenses such as pantry, and I mean, like, you have the miscellaneous expenses that you have, say for example stationery and so on. But again, do keep in mind the regulations surrounding the claiming of input tax. Okay, so if you've made I mean, if you've bought these things from a supplier, then obviously you need to have a tax invoice. Okay, or you're having a tax invoice and claiming is the only way to go about this one. And if you have, say for example, a receipt or a memo for the payment that you made, then obviously you cannot claim for these.
Understood. Next question that we have is from Mr. Aslam. He's saying, is it possible to claim input tax for the past invoices related to previous quarters if it's omitted to claimed?
Okay, now there is a cutoff specified by the FTA. If you have not claimed it in the current quarter, you can, I mean, there are expenses you have not claimed it in the current quarter, you can claim from the last quarter. But expenses before that, it's a little difficult, and the FTA does not allow for that. And if, but for example, say you've had an expense, or you've had a transaction where you have uh, the the supply has been booked. However, you have the intention to pay was only fulfilled during this particular quarter, or like, you release some amount of payment only in this particular quarter. Then in that case, yes, we can look into that. But again, it sort of depends on, like, what are the type of supplies, and what was the date of supply, and is there any chance. So it's not something that you can answer, like it's a cut and dry answer for that one. But we'll probably need to look into, like, the conditions surrounding the transaction in order to give a proper advisory.
Understood. Understood. Okay. Due to time constraint, Rosh will take the last question now, and it's from Mr. Albert. Since the questions are coming in huge number, but I'm sorry we cannot entertain all the questions. He's saying, Mr. Albert is saying, in case of group of companies, if invoice is raised in the name of only one company, how the VAT input is to be considered for other companies which are included in the invoice, group medical insurance, for example.
Okay, I'm not sure if I'm not able to understand the question properly, but if and this is what I assume you're asking, right? When it comes to a group of companies and you've had expenses that you would like to claim, say for example for one of the member companies, then if you are registered as a tax group, then you're filing your returns on, like, you're only filing one return by the elected member. The elected member is the only one filing. And if that's the benefit of having a tax group registration. That is, you only have to file one tax return for the entire group for a particular period. So obviously, I mean, like, if the member organization of the tax group has had any expenses related to the insurance of its employees, and you have the option. You do something called as a consolidation of the VAT return. I mean, the VAT of all the members within the tax group, and that consolidation, I believe, like, this will be a part of the consolidated working. So yes, you can claim the, but again, it sort of goes on to, like, the rules surrounding the, like I said, like the first question was asked, like, the rules surrounding the insurance. If it is in line with the FTA regulations of, like, one spouse and only up to three children below the age of 18. So these are the kind of criteria and conditions that are claiming of.
And understood. Understood. Thank you so much, Rosh, for answering questions from our wonderful audience. Though you're sick, you took it and you explained everything in detail, and very nicely you answered questions from our wonderful audience. And I would like to thank our wonderful audience for joining us. I can still see the questions coming in. For some reason, today's webinar was very interactive and we got a lot of questions. So So, in order to cater them, I would request you all to keep putting the questions, and someone from our business development team would reach out to you, and we'll try to assist you as much as possible. And on the other note, our QR code is displayed on your screen. If you can take a moment to scan the QR and give the rating on our reviews on our Google page, it would be very helpful for us to improve our services and improve our work. And thank you so much, everyone, for joining once again and making this session truly engaging. Until next time, if you have any further queries, excise, VAT, corporate tax, you have the details in front of you on the screen. Please drop us an email or give us a call. And in until next time, bye, and we'll see you in the next session. Have a great day ahead.